Most people are aware of the potential for gains in a rising market, but did you know that you could also profit in a falling market? Today, let's explore this concept in our tutorial. So what exactly is a contract for difference? Well, in simple terms, it's a derivative contract that allows the participating parties to exchange the price difference of the underlying asset between the trade's opening and closing time. The underlying asset could be anything from Forex currency pairs, stocks, indices, commodities, to even cryptocurrencies. Here's the interesting part. With CFDs, you can either go long, which means buying, or go short, which means selling. And the best part? You're not actually owning the physical instrument. You're trading on the possibility of its price moving up or down. Picture this. You're in a trade, and you're not trading the actual stock or currency pair. Instead, you're speculating on how its price is going to move from the moment you open the trade to when you close it. CFD trading operates through contracts that mirror the price movements of the underlying asset. For example, the CFD of Apple stocks will mirror the price movements of actual Apple shares trading in the stock market. Instead of specifying a fixed quantity, like say 100 stocks of Apple, you're dealing in 100 contracts. It gives you flexibility in your trading strategy. Just like buying and selling in the stock market, CFD traders can purchase and sell these contracts in the CFD market with the help of a CFD broker. But here's the interesting part. You get some extra perks like the ability to go short, sell first, buy later, leverage, and hedging. Let's talk about profits and losses. When you buy a CFD and its price goes up, that's your profit. However, if it goes down, you're looking at a loss. Conversely, when you sell a CFD and its price drops, you're in the green. But if it rises, that's where you'll face a loss. The real deal comes when you close your position by taking the opposite action of what you did at the start. If you initially bought the Apple CFD, you'll sell it to realize your gains or losses. Going long versus going short in CFD trading. Alright, let's get into the nitty-gritty. When you're opening a CFD, you've got two options, going long or going short. Going long means you're buying the CFD contract at the specified ask price. Now it's time to close the trade. You'll do the opposite, sell the CFD at the bid price. This is where the magic happens. You're pocketing the difference between the opening and closing prices of the CFD. Picture this. You believe the price is going up, so you buy the CFD. When it rises, you sell it back and pocket the profit. Let's talk about trading in a rising market. Imagine you anticipate that the price of silver is going to go up. So you decide to place a buy or long trade of one silver CFD at its current price of $25.5. Now, if your anticipation proves correct and the market price of silver indeed rises to $29.5, you're in luck. You can close out your trade by selling your contract at this higher price. This action settles the difference between the CFD's opening price and closing price. On the flip side, we have going short. This is when you sell the CFD at the specified bid price. Then, when it's time to close the trade, you'll do the reverse, buy back the CFD at the ask price. Again, you're pocketing the difference between the opening and closing prices of the CFD. Imagine you expect the price to drop. You sell the CFD, and when it falls, you buy it back, locking in your gains. Now, let's switch gears and talk about trading in a falling market. This time, imagine you anticipate that the price of the NAS 100 is going to go down. So you decide to place a sell or short trade of NAS 100 CFDs at its current price of $15,515.2. If your anticipation proves correct and the market price indeed drops, let's say to $15,505.2, you're in for a win. You can close out your trade by buying your contract at this lower price. This action settles the difference between the CFD's opening price, which is $15,515.2, and the closing price, which is $15,505.2. Leverage and margin trading. Alright, let's demystify the concept of leverage in CFD trading. Leverage allows you to open a trade by using only a fraction of the overall trade value. In simple terms, you're essentially borrowing a portion of the total value of a trading instrument to open a position. This is commonly known as trading on margin, and the deposit you make is referred to as your margin. Now, if you're wondering how to calculate your initial margin, here's a handy formula for you. Initial margin equals the total value of the CFD divided by the leverage. This formula gives you the amount you need to deposit to initiate a trade. It's a fraction of the total value thanks to leverage. Now let's talk about the two types of margins in CFD trading: initial margin and maintenance margin. Let's get started with the initial margin. The initial margin is the deposit required to kickstart a trade. It's the first step towards entering a position. Second, maintenance margin. The maintenance margin is the amount required to maintain the open position. If you fail to maintain this, your broker will issue a margin call, prompting you to deposit additional funds into your account. Failure to comply with this requirement and further losses will result in the immediate closure of the trade, thereby realizing any accrued losses. Here's an interesting point. If you don't keep up with the margin requirements of your trade, you'll receive a margin call from your broker, asking you to deposit additional funds into your account to save the trade from closing. If you don't, the position will be immediately closed out, and any losses will be realized in your account balance. To put this into perspective, let's say you want to trade a CFD contract with a total value of $10,000. If your broker offers a leverage of 50 to 1, you'll only need to deposit $200 as the initial margin to trade a CFD contract worth $10,000. Hedging with CFD trades. Alright, let's talk about a special feature of CFDs, short selling. With CFDs, you have the ability to open a sell position without the need to buy the instrument first. This opens up a world of possibilities, and one common use is for hedging. Hedging is like an insurance policy for your assets. It's a practice where you use CFDs to offset potential losses in your physical or stock portfolios. Let's break this down with an example. Imagine you have a substantial investment in Apple stocks. Recent market news has you a bit worried about the share prices taking a dip in the near future. Instead of immediately selling your Apple stocks, which might come with tax implications, you can opt for a different approach. You can choose to short sell the Apple stock CFD. If, as anticipated, the price of the stock does indeed fall, the loss in your share portfolio will be offset by the profit from the CFD position. Key differences between CFDs and stocks. Well, CFDs and stock trading may seem similar, but there are key differences you need to be aware of. From asset ownership to taxation, let's cover it all. Number 1. Asset ownership. In CFD trading, you don't own the underlying asset. You're simply speculating on its price movement. This can be advantageous for various trading strategies. Number 2. Voting rights. Unlike stockholders, CFD traders don't participate in corporate decision-making and do not possess voting rights because they do not possess the actual stocks. Number 3. Short selling and going long. Short selling is a breeze in CFD trading. You can profit from falling markets just as easy from rising ones. Number 4. Leverage and margin. Stock trading relies solely on a trader's own capital, as stockbrokers typically do not offer leverage. On the other hand, CFD brokers frequently provide traders with leverage, enabling them to control larger positions with a smaller portion of their own capital. Number 5. Long-term versus short-term. Stocks are typically viewed as long-term investments, allowing investors to weather market highs and lows over many years, ultimately aiming for a more substantial long-term return. Conversely, CFD speculation often involves quick bets on price changes, resembling short-term decisions made with the goal of generating fast profits. Number 6. Taxation and regulatory differences. Taxation and regulations for CFD trading can vary from those of traditional stocks. It's crucial to understand these differences to make informed decisions. Moving on to a bigger question. Is CFD trading right for you? We'll weigh the advantages and disadvantages. Now, let's begin with the advantages. Number 1. Liquidity and accessibility. CFD markets are highly liquid, allowing for easy entry and exit. This accessibility is a big plus for traders. Number 2. Diverse asset class. With CFDs, you have a wide range of assets to choose from. This diversity can help you diversify your portfolio effectively. Number 3. Hedging opportunities. Hedging with CFDs can be a game changer in risk management. It's a tool every trader should consider. Number 4. Leverage. The ability to trade with leverage provides opportunities for higher profits. However, it's crucial to use it with caution. Moving on to the drawbacks associated with CFD trading. First, risk of losing more than invested. Remember, with great power comes great responsibility. Leverage can lead to amplified losses, so always use it judiciously. Second, the cost and fee. CFD trading isn't without its costs. It's essential to be aware of fees associated with trading CFD. And that's all for today's lesson. We hope this video has been informative and helpful. If you enjoyed it, please give it a like and subscribe for more Forex trading insights. Thanks for watching, and we'll see you in the next video. Don't forget to leave your questions or comments below, and we'll be happy to help.